Hello and welcome to this edition of Financial Planner right here on Business Television India. I'm Fatima Mahdi and joining me on the show today is Poonam Raghuvanshi, who is the Executive Director at Anand Rathi Private Wealth Management. Thank you so much for joining us, Poonam. It's wonderful to have you with us right here on Financial Planner. Today I would like for our discussion to really focus on this whole idea of PMS or mutual fund. Can you tell us a little bit more about what this entire dynamic means?
Thank you, Fatima, for having me over the show today. So basically, there are many ways of investing in the equity fund, and of the two, the most popular ones are PMS, Portfolio Management Scheme, and Equity Mutual Fund. So they basically are a way of creating wealth and creating alpha over the assets that you have. So PMS, and so the decision to make investments either in PMS or in equity mutual fund, it's very important for the investors to understand the characteristics and the various other the features and the benefits that you derive out of each of these. So according to us, the PMS is a little more complex way of investing in equity stocks, whereas mutual fund is a more simpler manner to invest and grow your fund over longer periods of time.
Now, in terms of the factors, that really look at, that sort of break down an evaluation synopsis, I want to go through a couple of points here. We understand that, for example, performance, taxation, complexity, fee costs, you seem to have something that sort of shows that it's not, you sort of have a cross against that, versus those are all ticked off in a mutual fund. Of course, the one thing that's different between this also is a customization. Tell me a little bit more about these parameters that actually form the basis of valuation and once again sort of reflect mutual funds very differently from PMS.
Yes. So we have actually in Anand Rathi categorized 9 basic parameters which segregate or differentiate between investing into an equity fund. The 9 parameters that we have classified which differentiates PMS and equity mutual fund, the top of the mind that comes is the performance. If you compare a PMS with a mutual fund in the same category, the same strategy, let's look at a large cap and a multi cap. In a PMS versus a mutual fund, the last 3 years performance very, very clearly shows up the difference that strikes out. And in a PMS, we have data to show that last 1 year, the PMS has given a return of -1 or negative return, vis-a-vis a mutual fund which has, in the same category, has given a return of about 7.7 odd %, and over 3 years, a differential return of about 2%, 15.31 in a PMS versus a 16.9 in a mutual fund is what kind of stands out. And therefore, in terms of performance, mutual fund takes the cake. Second most important thing is the tax efficiency. In PMS, how it works basically is that there's a fund manager who buys and sells stocks on your behalf in your demat account. So it's a more personalized, customized one where it actually is a little different, and you can give a tick mark saying it is more customized depending on what I need rather than what I want, is in a PMS, versus in a mutual fund there is no customization. It is the same for everybody. But in terms of taxation, what happens is you pay a long-term capital gains whenever you buy after 1 year. So the taxability is straight 10% long-term whenever you withdraw the money as of now. But in a PMS, every time you buy and sell, there is a short-term or a long-term capital gains that you incur. So over a longer periods of time, whether you hold a PMS, one of the best PMSs, if you hold for 10 years, the taxability kind of increases and it continues over the period, over the journey of 10 years, whereas in a mutual fund, the fund manager can buy and sell any point in time. It just continues. So one of the differences again is that the mutual fund is governed by the Trust Act of 1964, and therefore there's a pool of money which gets invested into stocks. right? So in terms of taxability, mutual fund again beats that. The third most important thing, it's the complexity that you mentioned. PMSs are a little more complex, whether it is documentation, whether it is about the buying and selling that you do, but in a mutual fund, there's just one sheet of paper that you sign to invest or to redeem, right? So in terms of both of them, the complexity is much higher. And of course, the fee structure, which to my mind is much higher in a PMS. There is an exit load of about 3% to 4%, and then the exit plus there is a management fee of 2.5%. So the management fee continues even in a mutual fund equity, but the exit load that you pay in an equity mutual fund is just about 1% if you withdraw before 1 year.
Poonam, quickly, sorry to interrupt you, but I want to also also focus on just so that I better understand, regulation is a very important aspect as well. I want to just understand what it is that we're looking at when it comes to those watertight regulations that we've seen by SEBI. That is a stark contrast to what we see with PMS. Just a quick update from you on that.
That's right. Yeah, so mutual funds are all controlled and governed, and it's like you said, it's very watertight, compartmentalized by SEBI. There is a transparency there is a color code on mutual funds. There is all kinds of disclosures on the composition, the attributional analysis in a mutual fund, whereas in a PMS, it's little loosely monitored. And therefore, it's a little ambiguous, and therefore the control of SEBI to mandate a PMS to disclose what are the holdings is definitely not existing. So your PMS and my PMS may have different holdings, whereas if you and I were invested in a same mutual fund, it would be more transparent, and it is very, very, what should I say, the word is fluid. It's absolutely available and redeemable. Plus you have the SEBI mandatory, that is the rules and regulations that are applicable to a mutual fund, whereas PMSs are not governed so much by SEBI. So regulatory purpose, I would give a thumbs up to mutual fund.
Okay, definitely, because there seems to be a huge difference. Also, just a little bit in terms of how transparency works, because there's no transparency, or there's less transparency when it comes to a PMS, and of course, a mutual fund is very different. So, how do mutual fund managers really sort of communicate that transparency versus say what the other option is here?
See, every month the SEBI, it is mandated that the funds, each of the funds, whether it's debt or equity, they have to declare what are the holdings that each of the funds have, right? Whereas it is not mandatory for a PMS, a portfolio management scheme, to declare what are the holdings. Now, that is the transparency in terms of the composition. There is transparency in terms of cost, right? What is the fund manager charges as a fee for managing the fund in a pool, in an equity mutual fund, whereas the transparency is not so available in a PMS. A PMS is more customized, as we discussed, and therefore if I have a large volume of money going into a PMS, I can negotiate with the portfolio manager to reduce my costs. So that transparency is not available at all. So that is in terms of cost, there is in terms of the holdings. And of course, there is, besides that, the transparency is also on, as the funds become bigger and larger in equity mutual fund, it is mandated that charges have to come down, which is not available in PMS.
Poonam, just, given the fact that we're looking at all these evaluation parameters, right, that basically are giving investments into a PMS, say like a 1 on 9, 1 over 9, 1 on 9 actually, versus a mutual fund investment, which is say like an 8 on 9. Why is it even a question to be investing in a PMS versus a mutual fund? Because that's a huge gap that we're looking at.
Yes. Yeah. So, many a times this form of investments, a PMS, a client may want to just buy certain stocks, a more concentrated kind of 15-20 stocks. He may not have the capability to buy and sell. So he therefore gives it to a PMS. It's on a very large portfolio. He may want to have just say about 5 to 10% of the portfolio in a PMS. But mutual funds, over longer periods of time, irrespective of whether it's a concentrated, so even in a mutual fund you have concentrated portfolios. The name that comes to my mind is SBI Focus Equity, which has a concentrated portfolio. So, if you were given a choice between a concentrated portfolio or a diversified equity portfolio, I would still choose, I would at least recommend equity mutual fund over PMS. So there is, the fee factor. See, what happens is in the marketplace, the PMSs over shorter periods of time or a medium period of time have generated some better returns or alpha over equity mutual fund, but over longer periods, the people who have invested in equity mutual fund tend to get a better return, and therefore when investors see a huge alpha over a shorter period of time, they tend to get more attracted towards PMS. So therefore there is that need or hunger for PMSs. Otherwise mutual funds definitely win over.
Absolutely,
PMS.
absolutely. Poonam, thanks for taking us through this, including really the kind of, breaking down the reason why a mutual fund sort of wins over a PMS. That, of course, was Poonam Raghuvanshi joining us for this conversation. Thank you for watching. We're coming right back.